Why are
Thanks.
you expecting a more dovish Fed than the others?
Well, it certainly looks dire at the moment, but as we move through 2022, we do think that growth will be moderating. We'll be going through some bumps along the way. We're looking for first quarter growth to come in a little weaker than expected because of the effects of the Omicron variant, and then some catch up in the second quarter. But as we move into the latter part of the year, we do see growth moderating. The nature, the mix of it will change, but moderating overall. And we are hopeful that inflation will be coming down a bit, not dramatically. Services inflation picking up some of the slack as supply chains begin to improve, normalize again, but easing nonetheless. And that takes a little bit of the pressure off the Federal Reserve to move aggressively. So we are in the beginning of a tightening cycle, as the other analysts had mentioned, but we think that there may be a bit more caution as we move it to the back end of the year.
Gary, would that give some more support for emerging market equities, given that they really did not have a great year in 2021, but this GTV chart on the Bloomberg also showing that because of that, we're now seeing much lower valuations than, say, U.S. equities?
Well, valuations will certainly be helpful as we move through the year. There are still plenty of headwinds. The Fed will be in a tightening mode, or at least pulling back on that aggressive stimulus, not with the liquidity, the kind of tailwind that we had in 2021. And at the same time, we think the dollar will be firming through much of the year. On top of that, you have China in a development strategy shift, more moderate growth as well. So we see the current year is continuing to be a challenging one. But again, if you look through the prism of the beginning of the year, certainly looks more dire than we think it will be over the course of the year. And we think the dispersion of performance among emerging market economies will be quite wide depending on their circumstances.
What's your outlook for big tech stocks? I know Wells Fargo's got a call on this as bond yields continue to rise.
Well, at the moment, it is a difficult environment. Our group, the Wells Fargo Investment Institute, is still fairly constructive on the high quality stocks with the strong balance sheets. Barbell to some extent, mega cap, or I should say just the high tech sector in general, and the cyclicals, particularly in the industrial sector. The commonality, the U.S. market, staying with U.S. stocks, large quality stocks that have the balance sheet, the wherewithal to weather the kind of volatility that we expect to see. Certainly early in the year will continue to be challenging as policy expectations remain fairly hawkish. But if we're right on that policy outlook and the pressure on the Federal Reserve does ease a bit, and keep in mind fiscal policy won't be as stimulative as it was last year, and growth moderates during the latter part of the year, I think that takes some of the pressure off interest rates and provides a better setting for these long duration tech stocks.
Now, you're also lowering your outlook for emerging markets in 2022. What's your reasoning here?
For the, the emerging markets?
Yeah.
Well, we're neutral by and large on the emerging markets. The Asian economies, we think, are particularly well placed given the supply chain disruptions that we're seeing. Certainly Taiwan is well placed with semiconductor exports. But South Korea, as well as the supply chain continues to improve. The strength of the dollar, higher interest rates will hurt some of the more heavily indebted emerging market economies. The commodity producers in Southeast Asia may see headwinds from the stronger dollar to some extent on commodity prices. But the heavily indebted emerging markets really get a threefold effect from a stronger dollar. There are headwinds to commodity prices to the extent they are exporters. Their dollar debt payments denominated in local currency, the local currency equivalent, is that much more burdensome. And we could see a flow of funds from those local markets, much as we've seen from those local markets to dollar-based securities, forcing central banks to maintain a fairly tight bias toward monetary policy.
And there are so many idiosyncratic risks around emerging markets, right? Whether it's presidential elections here and there or regulatory crackdowns in China. Is there anything in particular that you're watching for 2022?
Well, we've seen some evidence of those idiosyncratic risks. Turkey is one prime example, and economies like Turkey that have large dollar liabilities that are dollarized, where their exports are improving, but not exposed to the export sector as much as some of the other economies out there are particularly exposed. More generally, countries that have large amounts of dollar debt, certainly keeping an eye on that, given the strength that we expect to see in the dollar through much of 2022. And then you get into some of the political elements. Certainly China, the development strategy changes, but Latin America moving to the left, and presidential elections coming up in some of the other economies that could create some turbulence in some of those economies as well.